I'll tell you a couple things that was amazing, and I know you had a guest on a couple segments ago to talk about this, but $15 billion in goodwill impairment, they dramatically overstated the value of the balance sheet. Now, that's a little odd to me that they wrote down so much of it. There is an awful lot of goodwill on the balance sheet of American corporations, so my question is this really a specific story to Kraft Heinz? I'd like to do a little look at the balance sheet of particularly other food companies and see what's going on. My point is this may be a bigger story than just associated with Kraft Heinz.
People have been pointing to Campbell's and Dr. Pepper and some other names. They're highly leveraged, right?
Yep.
Highly leveraged and had funded a lot of acquisitions in the past.
The other thing I would bring up is this reduction in the dividend. Now, Kraft Heinz had the highest dividend of any food company I knew. I don't know if you're going to put up the numbers here. We have a screen on this, but it was over 5%. There's an awful lot of food companies that are at the 4% level. So General Mills, Campbell's Soup, Kellogg's is essentially at 4% right now. I'm wondering if they're under any scrutiny or effect. There's a bunch of these. L Brands obviously is not a food company, but you get the idea here. There's a lot of companies out there that are in the 4%. Kraft Heinz was cut. They cut it by a third, so that's quite significant. The final issue I think is very interesting about all this is, Warren Buffett popularized the idea of economic moats. That is, do you have some competitive advantage? Do you have some low cost? Do you have an amazing product?
Yeah, these guys have no moat.
None, exactly. Which is odd that Warren would be so involved in the whole thing. I wish he was here today.
He's going to be there Monday.
I know, but I hope we can ask him that question.
Oh, we're going to believe
What kind of economic moat does this company have?
Going to be asked.
Now, you guys were pointing this out earlier. This company's been cutting costs for years to keep the margins up, and maybe they shouldn't have done that. Maybe they just should have spent more time investing in the company overall. And it's not just that people are changing their food habits. It's the way things are managed, too, on top of that. You got to invest in these products to make it more. So I know your prior guest was saying, oh, the food habits are changing, therefore, what do you expect? It's a little more complicated than that.
Carl had tweeted out earlier, if you look at these div cutters, these big name dividend cutters, you go down the list, now it's Kraft Heinz, and it was Bud,
yep.
GE. Yep. That's interesting in and of itself, these legacy companies that have gotten in a pickle for a variety of reasons that have now been forced to cut their dividends. Let me highlight a couple of stocks while you're here as well. You talk about value. Some of these sort of old line legacy tech companies that are getting a little bit of a bid, like Intel gets an upgrade today. Yeah. Yesterday it was Microsoft named as the top software pick. And those are the ones that seem to be highlighted, to your point, Bob, over some of these higher growth tech names, at least for this point in time. And who knows whether what the future trajectory of some of those big high-flying FANG names is going to be relative to the Intels and the Ciscos and the Microsofts that are seemingly now back in favor.
What's interesting, too, is we're still getting earnings in, and if you give a decent outlook, your stock is still going up, despite, I don't know if we can put up some upside movers here, but Roku and Wayfair. There's a very good example. Roku came in ahead, and they gave revenues above forecast. That stock's trading up nicely. Look at that, up 8%.
Wayfair's up 23%.
Yeah. Now, Wayfair does online home furnishing. I guess that's what you would call that. Their numbers overall were pretty good. Smaller loss than expected, essentially.
Well, their customers 22%. Were up. The purchase per customers were up. What that
year
says
to date, it's up 60%.
Yeah, it's crazy. Yeah. What it says to me too, at a time really this month. Look, we've been sort of debating what the strength of the consumer is after that dreadful retail number. Walmart and Wayfair suggest that if you have what people want at the price at which they're willing to pay, you're going to do fine. Consumers are still flush. Yeah. They still feel, from a confidence level, pretty well. And if you've got what they want and you got the price that they're going to pay and willing to pay, you're going to do fine.
And you're managing the company properly.
Yeah, of course. You can manage it well.
I just want to note, too, on the upside movers, there are reports out of Australia that Newmont may consider a bid for Barrick. That's a big, big merger in the precious metal space, and keep an eye on that. On downside movers, AutoNation. Again, if you miss or you give estimates short of forecast, you're going to move to the downside. So AutoNation reported revenue below forecast. That's down. You see Baidu there. They spent very heavily on content and promotion in their commentary. They're down a little bit. Dropbox forecast a drop in operating margins. You see that's down 9%. And this is not a typo on Stamps.com. Talk about losing your key customer here. They gave a weaker than expected forecast and announced they had ended their exclusive partnership with the U.S. Postal Service. You think that matters to Stamps.com? I think so. That's not a typo there. The other thing that I would just note, I don't know if we could put up the global markets. I mentioned this early, but I do think it's important because a lot of people have been trying to target, with the awful year they had in Europe, trying to pick out some value in Europe. I think it's pretty hard because, as you know, the economic numbers are just awful out of Europe. But see, this week here, this is the first time we've seen this in a little while, and so we'll keep an eye on that.
You want to take a stab at this city upgrade over at Jefferies? Better revenue growth. Stock's up 1% this morning.
I didn't read that one. No.
I'm just saying for a financials conversation at large, right? You've got a fairly bullish call on a name like Citi for a group that seemingly can't get out of its own way for a variety of reasons, whether it's parts of the business and then obviously what's been going on with rates.
Yeah. But the banks have been doing better recently. Even the big money center banks have been doing a little bit better recently.
Well, you better be if the market's been doing what it's been doing.
Yeah, I have a hard time with it because of the flat rate situation and the loan growth being so modest overall. I mean, we had 1% to 2% loan growth last year for all the big money center banks. That's pretty remarkably, I wouldn't say it's anemic, but pretty modest overall. The final thing I just want to mention is this whole Pinterest thing yesterday that we talked about, Lyft now. So we got companies now that are 9 or 10 years old. Finally, some unicorns. Finally, something is starting to happen.
Pinterest is 9 years old.
Yeah. I mean, the first round of funding was 2010, wasn't it?
Yep.
Yeah. So we've got Uber sitting out there. We've got GE Healthcare, enormous potential IPO. WeWork sitting out there. Palantir sitting out there.
Lyft.
Airbnb is sitting out. I put out Lyft. Lyft was what, 15 billion, as I recall. Right around there. So they're all sitting out there. These are just the big names. There's 120 unicorns that could potentially go this year with value over revenues over $1 billion, and 220 general companies that are out there. Half of them unicorns. So it's the big debate. We talked about this yesterday. Is there really an appetite for all of these companies? But I am very encouraged. Just the fact that they're finally getting pushed out, and let's bring them public. We all know, Scott, you've talked about this before, we had 8,000 companies public 20 years ago. There's 3,600 companies in the Wilshire 5,000. We have half the companies that we had 20 years ago, and the market caps values are much higher because the power is concentrated in very, very small hands now. S&P 100 essentially controls the world right now. I'd like to see that change.